Thanks, David. Again, thank you for having me on. If we can just move to the next slide, please. So, as David said, we are a company that is a large distribution group. We are turning over a bit over $100 million now. We're an industrial distribution company, which was founded in 2014 by myself. We listed it in 2018 on the ASX, and today with a head office in Western Australia, we also have a platform right across the Australia locations. We operate now three segments where customers obviously are served through distribution means, which is business to business, through retail, business to consumer, and also we have a specialist wholesale division, which is really focused on dealing upstream in the supply chain to be able to bring products to market. We have five main categories of products that we sell: industrial, safety, healthcare, automotive, and also workplace products. If we can move to the next slide, please. So to put some context behind our growth over the course of the last 4 years, our revenue when we listed was 24 million. Today, we're about 110 million. Our gross profit was at 18.4%. We're now operating around about 29%. We have undertaken 7 acquisitions and integrated those within our business, and that's allowed us to grow our store network from 2 stores to 70 stores in that period. So we operate in every state and territory throughout Australia. Our customers, as you can see, have significantly increased as well, from 200 to around about 8,000. We also have 34,000 individual consumers that will either buy online or buy from one of our stores. In that time, we've also increased our footprint, which now has 270,000 odd product lines held in our distribution centres, in our stores, and also on site, which we provide to our customers. So you can see our investment that we've taken over the last 3 and 4 years has been building that capability to, as David said in the very early stage, to a large distribution organisation, which we have today. Next slide, please. So the comprehensive mix of the lines that we hold, on the right-hand side, you'll be able to see a number of key brands which are quite prominent and leading brands in their own markets, not only within Australia, but also internationally. And on the left-hand side, the breakdown from subcategories covers a whole range of products that is an everyday need for every workplace, and whether that be for a moving vehicle, whether that be a head-to-toe cover from a safety perspective with an individual, or whether that be from a cleaning within a warehouse or on a mine site. So the companies that are presented earlier in the mining sector, we are heavily engaged in providing all the commodities that go to those particular work sites. So next slide, please. So our network, as you can see, quite comprehensive. We now have 219 employees. Our network of 70 stores is covered by 20 company-owned operations and 50 independent operators, which brings about our network capability and our reach right across Australia. That's allowed us to expand our network by about 35 stores over the last 12 months. And that's under a capital-light model. So there is a gap for us in the market to be able to create Australia's largest combination of company-owned operations as well as independents from a distribution perspective in the space in which we operate. Almost 40% of our staff are female, and they fill a whole range of roles from senior management down to interns. The products that we have in stock, I've already mentioned, but we also have access to on-demand products, around about another 600,000 items that we pull from about 2,700 different suppliers. And we only hold product within our facilities on the basis that they have a particular stock turn. So inventory is managed quite significantly. We have a specialist inventory team. We have technology that captures everything that moves both in and out and within a location within our facilities. And in doing that, we're able to have quite a comprehensive track and trace system, which allows us to forecast our demand planning. We have 5 online platforms, both for web shops, which is for the individual consumer, as well as B2B e-commerce functions, which we are linked with major organisations that has dedicated punch-out catalogues that allows us to receipt orders, and that seamlessly flows out to a pick node within our warehouses. Next slide, please. Taking in the corporate information, as I have mentioned before, we listed in 2018. We have just under 100 million shares. We're operating at 11 cents, clearly undervalued. In fact, we have different research that's completed for us, which is suggesting that our share price should be at least 3 times more than what it is today. We have a target over the next couple of years to get to in excess of 200 million in revenue with an 8% EBITDA. That's been a consistent theme, which we've had for the last 3 or 4 years. And we're on target to be able to achieve that. On the right-hand side, my fellow directors, Chris Warden, who was the former CEO and Managing Director of 7 West Media in Western Australia. We also have John Gropley, who was a former chair of Automotive Holdings Group and also Retrovision in Western Australia, and Simon Poitevin, former Managing Director of Bell Potter, and also played 59 tests for the Wallabies and captained 4 of those. So we have people who have worked with large, big corporates, organisations. They have been with us for quite a period of time now. And the intention was to bring on very capable people that have worked in big business to be able to support our ongoing growth. Next slide, please. So why should you invest? 95% of the products that we sell are non-discretionary items. So in the current market, we see tailwinds. That's demonstrated by the end markets that we play. They're very attractive. The industry sectors have everyday demand for the products that we sell. We have above market revenue growth, and we're able to achieve that not only through the distribution network that I showed you earlier, but also through the extensive range that we now have on offer. And we've also extended our range upstream and downstream of the supply chain to be able to generate more revenue and profitability through the organisation. As I said, we're a light CapEx model. We've probably saved in excess of about $150 million by partnering up with the existing infrastructure of independent operators. And in doing that, we obviously can hit the ground running. Next slide, please. Next one. Okay, so addressable market. We operate in a $52 billion market. We're currently targeting 200 million, as I mentioned, over the course of the next couple of years. But it's large, it's fragmented. The largest player is about 4% market share. That is in the Wesfarmers business. They don't operate in all those categories. In fact, we're the only company of our type in Australia that supplies all those different product categories within one organisation. And that's proving for us to be able to cross-sell our products. It's demonstrated by double-digit growth that we're getting within our revenue, and also the ability for us to be able to win new business by having more of a comprehensive model. And in that attractive market, the great thing about our product, because it is an everyday commodity, is we have repeat business. We have long-term relationships with a number of blue chip customers. We have a significant amount of contracts under arrangements, and we also have relationships that come back. So next slide, please. From a financial point of view, the first 6 months of 2023, which is from July to December, we had a record half year, we turned over just over 52 million. Underlying EBITDA was 2.4. EBITDA was 2.2. We've continued to invest in building our infrastructure over the course of the last 4 years, but we've also made 3 acquisitions in 2022 year, which we are completing the integration of those. So in doing that, obviously there is a cost of integration and there's an investment. We've always paid low multiples or purchased those businesses for asset value, which has allowed us to be able to not only get access to markets and customers, suppliers and product mix, but it's also allowed us to be able to invest in those companies and merge them onto one platform so that we can leverage the buying power of a larger consolidated group. Next slide, please. From a balance sheet perspective, we generated 1.2 million of free cash. Our CapEx investment was down to $600,000. We've reduced our inventory with a 9% reduction of sales. We've also repaid our debt facilities, and whilst our debt shows $10 million, $7.5 million of that is actually working capital facilities, which is an everyday business need. True debt is $2.5 million, which we will have that paid off within the next 12 months. And then the rest of our debt is obviously associated with working capital, of which we have $15.1 million of inventory. So we've worked pretty hard to make sure that we've maintained our balance sheet. Our debt has only come about through the last 4 acquisitions that we've made, which at that point in time was cheaper than undertaking at a capital raising with the low interest rates. Clearly that's changed at the moment. Next slide, please. In the second half of 2023, so that's the period from January to now, so in the first 3 months of the year, we actually had 12% growth, and it was a record quarter. And it's also a record quarter, a record 9 months for FY23. So we're up 17.4% on the same period of last year for the 9 months. We've won 3 large new contracts, which are currently getting onboarded, and they are in the mining and infrastructure sector, providing safety and workwear and personal protector equipment, as well as tooling. So we're actually allowing those contracts, which we've never won previously, to fall into a dedicated operating structure that allows us to not only account manage that, but also ensure that we've got the right products in the right place at the right time. And the contract values of those is about $4.5 million over the next couple of years. Next slide, please. I guess from our perspective, we also look at what are the growth metrics. So our daily transaction volumes are up 19%. Our average sales orders are up 5%. But our average sales per employee is actually up 15%, which means that we're getting more efficiency and more revenue uplift. Our actual gross profit per employee is 24%, which also means that we're being more efficient, not only through the introduction of technology and automation, but also the efficiency of being able to consolidate those integrations of the acquisitions to single locations so that we can utilise resources more effectively. Next slide, please. And again, thank you. So what's our strategy? We're a growth company. We still continue to be one. We have deliberately built our company to date around capability, infrastructure, customers, revenue, to allow us to then flip and focus heavily on profitability. So that's where we are today, and that's what our focus is moving forward. We want to be the market leading business. As I said, we're looking for an 8% EBITDA or a $200 million turnover over the next couple of years. We have not only one of the largest distribution networks in Australia, but we want the largest, combining company and independent operators. We see that there's an absolute fit and a gap in the market. And in doing that, there's a comprehensive swing of services that we're able to offer. By building scale and bringing in technology, so automation and AI, which is the latest craze, allows us to be more efficient and reduce our paper trail, our processing trail by at least 40%. And those efficiencies essentially mean that we'll be able to take more volume through our business with less processing or cost to process. Next slide, please. So as we head to 30 June 2023, we expect our revenue to be between 107 and 112 million, which will be a company record. Our net profit is expected to exceed our FY22 result, which was our biggest so far. Our debt will continue to be reduced, and as I said, will be paid off in the next 12 months. And all our growth metrics are obviously trending in the right direction. So what that's telling us is the market is actually still buoyant in the areas that we operate. We understand, obviously, there's inflationary issues across many sectors, but for us, we have priced reset a number of our product lines, a number of our services that has demonstrated about a 1.5% margin increase over the course of the last 4 months, and will continue to do that. Next slide, please. Our 2025 roadmap. So we're looking at integrating with those 3 business models. But the central buying office, this is something that we've just announced in the last 2 months, and that's coming to fruition. We've identified that there's $80 million of new revenue that is not there today, that is available to us to over the next 12 months. So it's a short period of time, and it's simply the revenue is there. It's an arrangement that we have directly with our independents and the suppliers. So we will look at bringing efficiency in not only our systems, but we will also have the direct relationships with the suppliers and sell that down to the independent operators. The independent operators are spending about $160 million a year at the moment on purchasing goods. So 80 million we've identified as in the top 10 suppliers only. And in doing that, there's a number of efficiencies on both sides of the ledger there. Safety and healthcare I see as the new frontiers for our business, particularly healthcare, which is a significant amount of money getting spread in that area. But healthcare for us is more in the workplace space. Not only the supplies and the consumables, but also the added services that come along with that and support. Last slide. Thank you. Okay, so from a growth or an outlook perspective, yes, there is uncertainty and inflation persists, and we're no different in terms of wages and supply chain issues and interest rates and everything else. We've managed that really, really well. We actually see through what I've presented already that through the commodities of products that we have and non-discretionary items, that the trading conditions will remain favourable for us. That's demonstrated by our growth in the last 12 months at double digits. Again, which continues to be a regular theme for our business. We have passed on a number of our prices, which we held firm for a number of months recently, and that's getting accepted and absorbed, and we're always looking to operate more efficiently, but we see margin uplift. From a future development point of view, we are a company that is looking to pay dividends over the next 12 months. And we'll do that at a target of between 30 to 40% of free cash flow that is generated. As I said earlier, the next frontier for our business is really around the safety and healthcare environment. We see a massive gap in that market. It's about 28% of our total revenue today, but we see that there is a high demand, particularly in the workplace, for services, support, and also for general consumables. It's an absolute demand. And lastly, the four acquisitions that we've made over the last 12 months, there's still a number of merger synergies that are available to that. So there's about $15 million that we've identified now from where we were previously in cross-selling opportunities with the existing customer base. And there's also about $1.2 million of profit out of 2.2 that we mentioned previously that would be available through the course of this calendar year that we will have access to in terms of rationalising our integration of businesses over the next 6 months. So, David, thank you. If there's any questions, I'm happy to answer those.
Thanks, Mike. A very detailed presentation, and clearly, to my mind at least, a hidden gem, a quality company that's bucking the trends, non-discretionary product range, which means that you're always going to be in demand, and have acquired a number of very interesting businesses that are clearly linked together well. I just have one question for you. We don't have much time, but one question for you in regards to the integration of those acquisitions. Are you happy with how the integration's occurring, and are the synergies that you identified pre-acquisition coming to the fore?
They are. The acquisition, so we've integrated from 6 businesses now to 4, and we'll go to 3 over the next 60 days. We've closed 6 branch operations and consolidated those into 1. We've also repositioned our sales force, and our total headcount from 249 people to 219, and we're still growing our revenue base. So that we have not cut heads as such, but natural attrition. So we've been able to absolutely generate the benefits from a financial point of view. We've reduced our product lines within the facilities by 10%. And one of the things that we've been able to increase, we had a crossover or cross-sell of 3% of all customers from products, and that's sitting about 14% today. Probably not as far as we'd like, but definitely an opportunity for us to get uptake in the near future as we head into 2024.